Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It will help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. A little different style of episode today. Firstly, we had just got back from London a little over a week ago, and we were hosting our annual SLF, or Specialist Lender Finance Conference, which, by the way, had our highest NPS score ever. The event hosts about 1,000 attendees, specialty lenders, credit funds, banks, lawyers, rating agencies. It was a really, really great experience of meetings, of content sessions, drinks. We've been hosting the event, for the last 4 years, and you can really feel, the continued excitement and growth in the SLF, or what we call here ABF, or Asset-Based Finance Conference. Starting in 5, 4, 3, 2, 1. Welcome back to our latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. A little different style of episode for you today. First, wanted to acknowledge that we wrapped up our last event of the year, SLF, or Specialist Lender Finance. The corresponding event here in the U.S. is Asset-Based Finance, essentially covering the ABF or SLF market, where specialty lending platforms look at different financing options from either credit funds, banks, capital markets. And it's really fascinating and interesting to see the continued momentum of this market in London and even to the broader European market. We had about 1,000 attendees in London. It's our 4th year hosting it, and I think it just shows the growth of non-bank lending since the GFC. And I think the crowd was phenomenal. Meetings all day long, great content, full content rooms, great engagement from the audience. And we ended it with a drinks reception at the end of the day, and some really interesting themes coming out of the conference. One is, I think you're seeing the continued rise of credit fund capital coming into the market. While it's certainly always been pieces of the market, I think you're starting to see a lot of the larger U.S. players moving, or at least growing, their presence in Europe. Some of that probably by design with the some of the macro issues here in the U.S., tariffs and some of the other things that we've seen in 2025. But the growth of private debt or private capital has really exploded over the last decade, and you're seeing that go into spaces obviously beyond the direct lending, which is what private credit has historically been synonymous with. And so you're seeing that into now the SLF market. And I mean, the growth has just been phenomenal. You're seeing platforms of all sizes, whether it be a startup, mid-size, or even those that are scaled up and now securitizing. I think it's just a fascinating cross-section of the non-bank lending market. And that excitement is clearly still there. So that was, I'd probably say, the top theme. The securitization piece. I know securitization rules and regs are changing in the UK and Europe, and I think you're starting to feel some momentum, from those changes. And certainly it was part of the discussion, at the event. And I think that will lend itself to greater volumes and greater traction in the coming years. And so that was certainly interesting to see. The other thing is we're seeing a real groundswell of support amongst the LP community, in Europe. We've always seen a real strong support from that community in the US, and certainly there's different regs for insurance companies and pensions and family offices here in the US or even in Canada. But you're starting to see that interest from European LPs in the various ABF asset classes. And so we hosted a roundtable with about 15 or 20 large institutional allocators, which was a phenomenal session, going through what ABF means, how to access some of these asset classes. So I think seeing, the growth amongst the LP base is just exceptionally exciting. And I think ABF, well, some figures put it at 40 trillion, 20 trillion, 10 trillion, 5 trillion, whatever the number ultimately is. I think it certainly has, real momentum behind it as we head into 2026, especially as LPs and others look to diversify away from your, down the middle, senior secured, type lending. And they look at all these different opportunities, whether it be your SME lending to music royalties to litigation finance to data centers and fiber and everything in between, lions, tigers, and bears. Oh my. So I think that was, phenomenal to see over the course of the event. And really, that community has been very supportive of the DealCatalyst journey. And I think seeing that again is always good. And so we've now wrapped up our calendar for 2025 and now look forward, to 2026 as it's going to be an exciting year. 11 events across three core regions. We have obviously the US, the UK, and now we've added the Middle East last year. And so you'll see a lot of events that you saw last year, but also some new, including the Digital Infrastructure Conference, a new event for us looking at all things AI, data centers, fiber, and the like. And then you'll also see us supercharge more into the fund finance market, which is very exciting to see. The other thing I wanted to bring up before we maybe get to some news items of the week and some things in private credit, good and bad, is we've just launched an ABF survey, and we'll be doing a special ABF survey podcast next week on it. And so if you haven't yet seen that in your inboxes, I'm sure it's in there somewhere if you want to dig it out. We surveyed, I think it ended up being about 128 respondents across GPs, LPs, and specialist lenders. And so we'll, let the podcast next week to dive a bit more into it. But I think you'll find there's some fascinating trends in that ABF survey, and just a hat tip to keep a lookout for some more things coming from DealCatalyst when it comes to surveys. So we do ask that those in our community participate, tell us good, tell us bad. We rely on you for a lot, and so please do respond to those inquiries when we do send them out. We take a lot of your feedback very seriously, and we also want your input on surveys as we look to gain more interest and insight into where our community is going, what you care about, and kind of where you see the markets that we cover, which tend to be private markets, over the next year, 2, 3, 5 years. And so we appreciate your continued support on some of that stuff. I also wanted to bring up some fun things that I'll be doing on this show in the coming weeks, including maybe adding some additional days for the podcast, including talking sports and some other bits. So keep a lookout for that. I'm going to try to keep the core show, this show, on later in the week, and then we'll start to play around with some sports and other things earlier in the week. And ultimately, I see it as this should be fun and informative. And I think interviewing guests on the credit markets is it's a passion for me. I love doing this show. I love that our community has obviously gravitated to it, but I also want to have some fun with this and mix in some things that are passionate for me, which is obviously sports. I love watching sports. Pretty much all I do, other than work and obviously hanging out with the family. But sports have always been a huge passion for me, and I think there's a lot of crossover with sports and financial markets and even the credit markets. And I think you're going to start seeing a lot more of that from me. Some of it's just fun and passionate for me. Some of it I think will cross into kind of where some of these markets that we cover are going. But just a little insight into why you might start seeing more of that from me. And to me, it's just I like having fun and talking to the community. So if you want to participate in that, I'm always open to ideas. So please do reach out to me either on LinkedIn or just ping me an email. Just first name, not last name, todd.anderson@dealcatalyst.io. I'm always interested in talking to people about credit markets, non-credit markets, tangential credit markets, sports, and everything in between. I think this is a great venue to have some fun, and I hope you see you see that as well. Some other things I wanted to get to, because there's been a lot in the news with private credit over the last, say, 3 or 4 months, in particular when it comes to negative news, with First Brands and Tricolor, and there's been some other stuff out there as well. And, I think there's a lot of angst, in these markets today. Some of that probably overblown from the media. Some of it not. Clearly, there's issues around liquidity. Clearly, there's issues around, what happened with both First Brands and Tricolor. And so I think there is right to have some angst, but what level of angst I think is the key. And so Mark Rowan at Apollo penned an op-ed for Bloomberg, which I'll link to in the show notes, and he had come up with 4 myths, in private credit. And I think it was an interesting piece, especially hearing from someone as as high up as Mark Rowan, and seeing. I mean, Apollo could be arguably one of those the biggest name, or clearly one of the biggest names in private credit. And I think it was interesting to see what he brought to the piece in terms of those myths. And so myth number one is private credit is not rated, and that's clearly a myth, given that a lot of private credit is investment grade and either rated internally by banks or rated by rating agencies. And so I think it's interesting that there is a feeling out there as if this is all super risky, non-rated, below investment grade, when the reality is, the opposite of that is true. Myth number two, private credit is opaque. He actually thinks that it's more transparent than public credit, given the deep due diligence that lenders do perform. I think this one is a bit more argumentative, that you can get with it, given the notion that private credit is, at least in some ways, private. And does the access of one lender, does it necessarily match the access of another lender? I think and this is some of the stuff I got into the episode with Stuart Wall at Set Point, is what is that level of consistency across different lenders, and are there tools? Obviously there are some that are growing in the markets that can solve for this, and is the very nature of private credit meant to keep some of this private because lender one has a secret sauce that they think is better than lender two or lender four or lender 10. So I think that one can go a little bit more either way. Number three was private credit is not tradable, and he mentioned 6 billion that Apollo had traded in 2025. I think this is something I've asked a lot of guests as well, which is a secondary market for loans, and it does kind of play into the question before, which is the due diligence and underwriting from one firm to the next. Then is the information accessibility equal when these are then sold on secondary markets, and what does that mean for buyers? And so I think I think generally speaking, I understand what Mr. Rowan is doing, but I think in some ways it's not as clear cut as he's also trying to make it be. And then number four is private credit is an emerging risk to the financial system. I think this one I certainly agree with in the sense that, the concentrated risk in the GFC was all of this lived on bank balance sheets. And that was in and of itself significantly higher of a risk than where a lot of the risk sits today and the long dated nature of this and who holds the risk. But there was also a tie-in back then with insurance companies and ultimately AIG holding $80 billion that they did not have, and then the government bailout. And I think the shifting of the risk, and I myself have questions around where the risk sits and with whom for how long and who's ultimately lending to whom, because once you start getting into, the different areas of private credit, who owns or who's lending to whom, private credit funds are now lending to other private credit funds. And then there's, with the lack of liquidity in the market today, I think you're starting to see a lot of continuation vehicles, at least I've been told by many number of market participants. And then what does that mean? And where do the bad assets go? I think there's a lot that I think is still being kind of figured out through some of these new structures. And I'm not sure we all have great understanding or insight as to where the biggest risk lies. I do think diversifying away from everything being on bank balance sheets is obviously better. So I think in that sense, he certainly has it right that all the risk is not concentrated on one sector anymore. I think there's still a lack of true transparency on kind of where all the risk sits today, and levering that up, and is it leverage on leverage in some cases? I think there's still a fair amount to be worked out, and I think some of that leads into another story I saw, which was the Bank of England now looking to do stress tests, and a lot of this is voluntary stress tests on both private equity and private credit markets. And some of those same firms, Apollo and Bain and Carlyle, KKR, Blackstone, CBC, GSAM, all have opted in to this stress test by the Bank of England, looking to get a better sense of private equity and private credit markets. Now, the report's not going to be out for upwards of 2 years, but I think we're going to start to get a better sense from regulators, as well as market participants, as to kind of where some of this stress, current stress, future stress is going to sit. And ultimately, will some of the issues we've seen today, I think there's even 2025 alone, there's been 40 plus lenders who've taken over companies. Like, at what point are we coming up to a tipping point? Are we on the path to that? Is just some of this a natural evolution of private markets and kind of where where we're going? And as things diversify away from banks and move into other areas of the market, is this a natural evolution of that, or is there another real risk hiding amongst these these balance sheets, whether they be credit funds, insurance company, and the like. I think obviously the moving away from just banks is great. But I still don't think there's a great handle, and maybe the regulators will get a true handle on this. We'll see in the coming years, but I think it's interesting to start seeing issues like that. I mean, you also had Mubdala, who's invested 20 billion of capital into private credit, continue to back the bets that they've made. And I think when you start seeing LPs of that size and scope back the general sense of the market that private credit is safe, and the likes of Mubdala are not going to just willy nilly jump into a market. I think that also gives the market a lot of momentum. So I think it's kind of pockets of stress today, and I think it's going to take a little time for that to kind of filter itself out. But I think it's been a really interesting few months for the private credit market. I think there's a lot of tailwinds for the space. I also think there's things that in some ways are good that they happen in small spurts like this, because then maybe doesn't head off the real systemic nature of these markets. And I think that's obviously something that we all don't want to happen, similar to at least getting anywhere near the the GFC. And so I'll link to some of these stories in the show notes. I think it's really, really interesting. And, we're going to have some other stuff coming up on the pod in 2026. Some cool features beyond obviously the addition of doing some more sports and some fun stuff on Tuesdays. You'll have the core show continue on Thursday/Friday, and some just phenomenal guests and people that are in the pipeline. I think this show is really helped us continue to keep a great pulse on the market. I appreciate all those who continue to listen, and I look forward to seeing you again next week. So everybody have a nice weekend. Hope you had a nice Thanksgiving, and until next time. All right, bye-bye. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.